What's up, everyone? We got a really good one today, and so strap in. And of course, all the OG house cats drop a meow in that chat. You're watching More Money. Let's get it. H&R Block has been absolutely ripping over the past year, and you can see that it's up over 66% or just over 66%. But, the point I wanted to make here is that, you can have strong gains with boring names. And, you see that on this channel a lot. I don't know if there are other channels on YouTube. I'm sure there are. There's some really smart people out there. But, we've shown, over and over again how you can really make strong gains that, beat the market. And it's usually with these boring names that, have defensive characteristics built in inherently into the names and into the valuations. And so that's the area that I typically play in. It's one of the reasons why my channel's obviously not as big as, some of the channels that focus on some of the more popular names, predominantly in the tech space. And so the question with H&R Block is, what was the story? What got us attracted to H&R Block? Because, it's at $64 now, but note that there was a lot of people that followed this channel that actually ended up purchasing that stock for under $30 per share. So they're celebrating with just over a double right now. And so what caused it? And what caused it is the share actually dipped a couple of years ago on the news that the IRS was going to launch a free tax e-file pilot program. And I don't remember if it was slated for 24 at the time. This article is only from just over a year ago, but these articles have been coming out for a while now, and it scares people on H&R Block. But the other thing that people get worried about with a company like H&R Block is the fact that the DIY softwares are getting better, and so they're going to attract more and more people into that area, like you filing for much cheaper. But the thing about it, and the item that I always point out, and just from somebody who owns a tax prep company, is that the people who are using H&R Block, they're not concerned about the cost of filing. Like, if your business makes $500,000 a year, what do you care if you pay $2,000 or $4,000? Like, yes, you want to pay less, but you want to make sure that it's right. And these types of people don't necessarily want to file themselves if there's a risk that they could be wrong with the IRS. So there's more than just cost, and it's something that I try and point out. As the DIY softwares get better, and as the tax filing system gets more streamlined, sure, you're going to lose people to the DIYs, absolutely, and you're going to lose some of those DIYs to the free software programs that's offered by the IRS. But those DIYs and those free software programs, they don't actually guarantee that you're getting all you're filing appropriately relative to your situation. And that's where you need a preparer, and that's where the CA firms or the H&R Blocks come in, or at least allegedly they come in, right? You would hope that your H&R Block person who's helping you with your taxes is good. I've seen people have tough experiences with H&R Block, and they've come over to my firm, or at least the firm. When I was accepting clients, they would come over. But I've also seen people get really good service at H&R Block as well. It just depends on the preparer that you get. And truthfully, coming back to the chart here, I actually know seasoned CPAs, people who've been CPAs for more than 20 years, who still take their tax work to preparers, whether it be H&R Block or other firms, because they don't want to deal with the headache of the letters that come from, in the Canadian cases, just CRA, in the US cases, the IRS. They don't want to deal with those letters. If there's any headaches, they just want to be able to throw it to a tax accountant and have the tax accountant deal with it. So that's also what they're paying for. They're busy enough. Work is difficult enough. They don't want to have to deal with additional issues as it relates to the tax authorities. And so that's another reason why a company like H&R Block has value. And the whole time when it was trading at around $30 per share, that's what I was kind of trying to relate. This definitely is one of those names and one of those situations that was in my circle of competence, and we were able to see the value in them. So I'm really happy for a lot of the early subscribers to Patreon who actually ended up doing well. And in fact, you didn't need to subscribe to the Patreon because I was making videos on it, and so even if you weren't subscribed, there was people getting in on this at, under $30 per share. So congratulations to all of you guys. And so what happened with their FY24 results? Well, the stock actually surged because the company actually reported a 4% increase in earnings, but more importantly, they increased their dividend. And I think that's really what's causing the share price to increase. But, as somebody who's sitting on this, who has a model built on this, none of these results or the increase in the dividend or the increase in the share price repurchase authorization, none of this is new, right? Because we've talked about the strategy on this channel already. You buy back shares, so your total dollar amount that you're paying for dividends declines, and then you increase the dividend. And so ultimately, the total dollar amount that you're paying for dividends remains the same, but the dividends per share increases, and you could technically increase the total dollar amount paid for dividends as well, because your revenue is also increasing at 3 or 4% a year. And so that definitely hits the bottom line. And so that's really what's happening. That's been the strategy for years. This is a steady Eddie name. And I think the market is just coming around to realizing that this is a safe name in an environment where we could potentially be going into a recession. Dividends are valuable right now, which is why the utilities and some of these REITs are running up. And so H&R Block is just seen as one of those names, which of course is one of the reasons why I think it's closer to more appropriately valued at the moment. And so you can see with the capital structure, nothing has changed. The company bought back 5.5% of the outstanding shares, which in my opinion, I think was a little bit high, which is good. Not a bad thing at all. The share price that they purchased them at, $43.66, is absolutely great, considering that the price per share now is $64, I think. The new share purchase reauthorization, $1.5 billion. That's just going to continue as they purchase more and more shares. They're just going to continue to increase the share repurchase authorization. So they almost are better off with just creating an authorization of $100 billion, so they don't have to keep announcing it. But I understand why they do, because the market likes to hear this stuff incrementally. I get it. It's marketing, if anything. And then, of course, the increase in the dividend, which is what I believe is causing the share price to increase. And, I would say that if you are looking for share price increase surprises in this name, I mean, you shouldn't be surprised, but this is just going to continue to happen as they buy back more and more of the shares. They're returning 100% of free cash flow, and that's been the strategy for a long time. And the way that they're returning it is through dividends and buybacks. Now let's look at the outlook, and actually, I'm going to warn you guys that the outlook is not as good as you think it is. So be careful, because revenue growth is actually expected to be slower in fiscal year 25 than it is in 24. It's at the low end of their long-term range at 3%. So be careful. So they just grew revenue at 4%, and now they're slowing down to 3%. But what's interesting is they're saying that their tax rate is going to be 13%. So that's going to be definitely positive to the EPS line. However, I'm not going to forecast out 13% indefinitely. So in my model, if you have access to the Patreon at that lower tier, it's just $5 a month. The link is in the comments and in the description of the video. You will see that although I forecast 13% for next year, every year subsequent to that, I go back to the 21.5%, which is what they've sort of been averaging at. And so you can see here very clearly that, they had that post-COVID surge because nobody was filing taxes, blah, blah, blah. But now we're sort of normalizing. And so they got that 4.2% bump, but be very careful because their guidance is suggesting a 3% revenue growth increase. Now, their long-term guidance is between 3 and 6%. So I would say that if they're forecasting for fiscal year 25 to be at 3%, they're at the bottom end of the range there, and I would want them to explain why they're not closer to 4%. Last year, or maybe a year before, I expected them to be consistently at 4% for fiscal year 25 and beyond. And so the fact that I had to trim that down and bring it to 3%, because that's what their guidance is a little bit concerning. So the question is, should I be forecasting 26 and 27 closer to the midpoint of that 3 to 6% range, or should I be forecasting this out at 3%? I don't think ultimately it materially impacts the valuation in any way or significantly, but it's something to be, something interesting and something to watch out for, just because they did provide that guidance previously. And so this is what I was saying in terms of the valuation, just using a terminal multiple of 15 times earnings. I'm valuing this company at around $63 per share. It's trading at $64 per share. So, you're pretty much bang on at a reasonable valuation for this name. And so I want to go back to this chart, and I just want to ask you guys what you think. Is this a name worth buying? Are you going to sit on the sidelines here? Or you know what, if you are one of the people that did buy in that $30-$40 per share range, let me know in the comments below, and let me know if you're going to continue to hold on to this name or if you're going to try and take some gains here. I think I'm just going to leave this in my portfolio. It's been there for a couple of years, and yeah, I'm just going to let this thing sit. It's a steady Eddie. I'll hold it for 30 years or whatever. And so I'll leave it there for you guys. You guys let me know what you think on H&R Block. Is this worth buying, or have you missed the boat? Let me know, guys. Okay, see you later.